Hey everybody, Clay Rockwood here. Today I'm doing another deal deep dive. Okay, so these are real numbers on an actual deal that we just closed a couple months ago. So this is not hypothetical. I really want to show you transparently the actual deal structure and the full numbers of an actual deal we just did, because I think that's helpful. A lot of people ask, hey, can you give me a breakdown of the numbers? How does this all play out? What does it look like? You know, how do you look at these deals and underwrite it? So I'll talk a little bit about that today in this video. So this deal I'm going to talk about today is a 44-unit townhome project that we just purchased in San Antonio, Texas. Okay, this is a great opportunity, great market. So first thing we always look for is emerging markets or very strong markets with potential for growth, right? So San Antonio, we love that market. We buy a lot in Texas and other select markets around the country. So this opportunity we actually found through a broker. It was an off-market deal. They brought it to us first before they listed the property. And so this is how we found it, right? Through a broker locally in that market that we've been working with for a long time. The beautiful thing about this deal is that, like I said, is a townhome style apartment complex, right? So every unit has a ground floor entrance and a second floor as well. So it's true townhome style, which we really liked. It adds a lot of appeal and desirability for a tenant who may want to live there. So we ended up originally putting this deal under contract for $4 million. So the interesting backstory on this is right as the market was shifting or beginning to shift, rates started going up. You know, we were under contract on this property and we came back to the seller and said, hey, we can no longer pay you $4 million. The debt doesn't work. The numbers just don't pan out. So we were able to get a $500,000 price reduction just because of the market conditions, which was great. So this turned this into a deal that may not have worked into a deal that now worked. So we ended up purchasing the property for $3.5 million. That's just over $79,000 a door or a unit. That's a metric we always look at, is price per door, right? And you can kind of easily compare that to other properties in the vicinity to see what other properties are selling for per door. So anything in Texas under $100,000 a door is definitely worth looking at. So we definitely got a decent deal on this, well below market value. Now, the interesting thing was the owner that owned this had renovated a handful of the units, maybe less than half of them, had done a light rehab on them, but really hadn't done much curb appeal and wasn't really running the property that well, and they just wanted to get out of the property. So we always look for opportunities for value add, where we can add value either through renovations or through operations, and I'll talk a little bit about that. So our renovation budget here on this property is about $460,000. And that's about $10,454 for a door. So we're actually putting quite a bit of money into these units and the exterior, etc. I would say on average, you know, when we're looking at a light value add property, you're going to put anywhere from $3,000 to $4,000 a door, maybe $5,000 to $6,000. On a heavier lift, it's going to be anywhere from $10,000 to $20,000, even up to $30,000 a door if you're doing a full renovation and gut, right? So $10,000 a door is not insignificant, but it's kind of mid-range, right? So what we plan to do with this property, and we're already started, we've replaced all of the roofs on the property already. We're gonna go in and finish out the renovation on the additional units, right? So that includes new LVP flooring, resurfacing the countertops, painting the cabinetry, and bringing in new appliances, right? So we're freshening up all of the units and repainting all of them to make them look fresh and new and inviting. And then we do a lot on the curb appeal, right? So we're getting new signage on the building, repainting the entire exterior, kind of modernizing it, redoing some of the landscaping. There's a pool on site. We're going to put new, fencing around that, etc. So we're always looking for ways to improve the property, but also improve the safety and the well-being and the enjoyability for the tenants, right? That's part of our mission, and our core values is taking care of our tenants and providing a safe, clean environment for tenants to live in. So that's what this renovation budget includes. Now, let's talk about the rents, okay? So the reason we like this is the rents, when we bought it, were at about 97 cents per square foot. Now, that's a simple metric we always use, is price per square foot. It's a lot easier to run comparables when you're looking at a price per square foot basis. This was literally the lowest price per square foot rents compared to any other property in the vicinity, right? Within miles. So we knew right off the bat, hey, there's some room here to raise rents. Now again, we don't just raise rents arbitrarily, we want to raise them by adding value to the tenants, right? So that's why we do these renovations and add value that way. But we believe once we do these renovations, we'll slowly raise the rents up to $1.25 per square foot, which is more in line with the market rents, what they should be paying, what they should be renting out for. So let's talk about operations. So what else can we do on these properties, or what are we planning on doing on this property to make operations more efficient? That's another value add that we always look for, is not just in renovations, like what can we do to actually physically improve the property, but what can we do behind the scenes to make things more efficient and run smoother. So the current expense ratio when we bought this from the current owner was about 65%. Now what does that mean? We always look at expense ratio. So if your income, right, if you're bringing in $100,000, let's say a year in income, right, in rent in that property, that means your expenses were about $65,000. That's very high. That's unusually high. Expense ratios should fall, again, for a property of this size and where it's being managed by a third-party manager, in the anywhere from 45% up to 55% range, right? So we knew right off the bat, looking at the current owner's profit and loss statement of where they were spending money, how much they were spending on different items, that we could decrease that to the more realistic range of 50 to 55%. So that right there, without doing anything else, can increase your net operating income, can increase your revenue. And what does that do when you increase revenue? It increases the value, right? Commercial real estate is all tied back to the revenue or the net operating income. That's what determines the value. So we knew right there with the operations tied in with the renovations, we had a lot of value to add to this property and upside potential, right? So, once we do that, obviously we're getting a third-party manager in place, we're decreasing expenses. Another thing that the current owner wasn't doing was charging tenants for utilities. The owner was literally paying for majority of all of the utilities: gas, electric, water, sewer, garbage. That's unusual, right? Normally tenants will pay for a handful of their own utilities, if not all of the utilities. So that's a simple and easy way, again, to decrease your expense ratios and increase revenue. So what's our plan here on the sale? So we have here a number, again, this is an estimate. We haven't sold the property yet. We just purchased it. But we anticipate this property selling for $5.8 million in a matter of 3 years, and we'll talk about that in a sec, for about $132,000 a door. Now again, this is after we've implemented this whole strategy I've already talked about, right? The renovations, the operations, slowly increasing rents, making the property more safe. And I didn't even talk about that. We're resurfacing the parking lots. We're going to add security cameras and lighting, things like that. So again, we're adding value by making a safe environment for people to live. So that's the plan, and we're basing this off a 6% cap rate. Now, I'm not going to go into the details of what a cap rate is. I've made other videos that I explain in more detail cap rates and valuations on commercial properties, but we're underwriting this assuming we can sell this at a 6% cap rate. Now, that's a conservative number. In the market, all the other properties have been selling between the 5 and 5.5% cap rate. So the lower the cap rate, the higher the sales price. So we're buffering this a little bit and saying, hey, we're going to even assume this is going to sell for less than we think it realistically will. But again, it's just a cushion to give us security and safety especially in an uncertain time like now, where the market could continue adjusting downward, pricing could adjust. So again, we underwrite deals very conservatively, and we're assuming the same on this project. So what does that look like on a return basis? So like I mentioned, we're planning on selling this in 3 years. We think it'll take 3 years to implement this whole strategy. Give us time to do the renovations, the operations, get the property stabilized, and gives us time to then sell on the open market. What this will return to our investors is about a 22% IRR. Now again, I've done other videos on IRR and these different terms, but the internal rate of return is a metric we use a lot to analyze a deal and see what kind of returns we can give to our investors, right? Because again, we're syndicating this deal. We're pooling money together from other investors to purchase this property. So we're anticipating about a 22% annualized return is basically what that means. So this is a great return for investors. Anything above, honestly, a 17, 18% IRR is a great deal. So again, we're anticipating well above that, which is a great return for our investors. They were super happy with this opportunity. And then a 1.8x multiple. Again, this is just a metric we use to analyze what kinds of returns or what kind of equity they're going to get on their investment. So if they invest $100,000, again, you take the equity multiple, times it by this number, basically saying if you invested $100,000 At year 3, after you've been paid all the cash flow, everything in between, you're gonna get $180,000 back, right? It's a very simple metric to use that investors like to look at because they can just do the simple math, say, okay, if I invest X, I'm gonna get X back, right? And again, a 3-year hold. So hopefully this was helpful, guys. I kind of want to just break down a real live deal that we literally just bought and we're implementing right now. We've already started renovations, so I'm super excited. These are the kind of deals we love to do. These are the kind of numbers that we look at and that are important to understand when you're analyzing a multifamily property or any type of commercial asset. Really, you're gonna wanna break down these types of numbers to try to understand the overall scope of the deal and what the numbers mean. So hopefully this video was useful for you guys and gave you some ideas or some information to help you either get into your first deal or continue to scale into larger deals. Go ahead and like this video and please subscribe to the channel. I'm constantly putting out more content to add value to you and to help you in your real estate journey. Hey, thanks for watching, guys. If you want to join our free investor club, go to our website, soarcapitalgroup.com. You can sign up for free and you can be added to our exclusive list of investors, of partners, of people that are learning the ins and outs of investing in large-scale multifamily or mobile home parks. We'd love to help you out and work with you on future opportunities. Thanks so much. Hey, thanks for watching, guys. If you want to join our free investor club, go to our website, soarcapitalgroup.com. You can sign up for free and you can be added to our exclusive list of investors, of partners, of people that are learning the ins and outs of investing in large-scale multifamily or mobile home parks. We'd love to help you out and work with you on future opportunities. Thanks so much.